All right, welcome. If you're going into management, what's your number one goal? It's maximizing profit. Simple. But what if you didn't have any competitors? What if your company was the entire market? Well, that is the incredible position a monopolist finds itself in. So today, we're not just going to talk theory. We are going to build the actual step-by-step blueprint that a monopoly uses to make its most important decision, how to set its price and quantity to make the most money possible.
Okay, so before we can really dissect the monopolists, we have to lay down the single most important rule in all of production economics. I mean it. This is the bedrock principle. It's what every manager, whether they're running a food truck or they're the CEO of a tech giant, uses to answer the fundamental question: how much of our stuff should we actually make? This is our universal starting point. And here it is, the golden rule. Produce where marginal revenue equals marginal cost. MR equals MC. Let's make this super concrete. Imagine you run a software company. The marginal revenue, that's the cash you get from selling one more software license, might be, say, $50. Now, the marginal cost, the cost to sell that one extra license, it might be almost nothing, right? Just a little bit of server bandwidth. So of course you sell it. But what about the 10,000th license? See, now to sell that one, you might need a whole new server. That has a pretty high marginal cost. This rule, MR equals MC, it tells you to keep selling licenses right up until the cost of supporting that one extra user is exactly equal to the revenue you get from them. That's your profit maximizing sweet spot. You go one unit beyond that point, and you are literally losing money on every additional sale.
Now, this is the absolute key distinction. A firm in a competitive market, think of a wheat farmer, is what we call a price taker. They just have to accept whatever the market price is. So for them, marginal revenue is just that price. But a monopolist? A monopolist is a price maker. They face the entire market demand curve. And what that means is, to sell one more unit, they have to lower the price for every single customer, not just the new one. This totally changes how they calculate their marginal revenue, and it's the source of the incredible power we're about to unpack.
So, how does a monopolist actually put this unique power into practice? Well, it really boils down to a very clear, repeatable, three-step blueprint for leveraging their market control to rake in the maximum possible profit. The sequence here is absolutely crucial for any manager to understand. You don't get to set the price first. No. You have to first figure out the optimal quantity to produce, and that's based on your internal costs and revenues. Only after you've done that can you then go to the market and figure out the highest possible price your customers are willing to pay for that specific amount of product. Then, the final step is just a reality check. Is this whole strategy actually making us any money? So let's break down each of these steps.
Okay, step one is finding that optimal quantity, what we call Q star. This graph you're seeing, it's a visual of the manager's decision-making process. You're looking at the data for your marginal cost and your marginal revenue, and right there, that point where they cross, that intersection, that is your production target, Q star. As the manager, you tell your team, produce exactly this much, because if you produce any less, you're leaving money on the table. If you produce any more, your marginal cost is higher than your marginal revenue, and you're actively destroying profit. This is that calculated sweet spot we talked about.
So once you've set your quantity at Q star, now the monopolist gets to wield their true power. They don't look at their costs to set the price. No. They look straight at their customers, the demand curve. That line tells them the absolute maximum price the market is willing to tolerate for that exact quantity. So you just trace a line straight up from Q star to the demand curve, and boom, that point P star, that becomes your price. And this is only possible because, remember, your customers have nowhere else to go. And finally, the bottom line calculation. Is this whole thing actually profitable? So the manager compares the price they're charging, P star, to the average total cost of producing each unit, the ATC. If that price, P star, is higher than the ATC, the company isn't just making an accounting profit, it is earning what we call economic profit. And that means it's making more money than its next best alternative. It's a return above and beyond its opportunity cost. And for a business, that is the true measure of success. You see, when a monopolist executes this blueprint, it leads to the single most important outcome of having monopoly power, something that sets it apart from every other type of market. It's not just about making a profit for a quarter. It's about building a sustainable, long-term profit engine.
This quote really gets to the heart of it. Supernormal profits, that's just a fancy way of saying the kind of insane returns that go way beyond just covering your costs. Think about the massive profit margins of some of the early tech giants. But the real keyword here is sustained. In a normal competitive market like the restaurant industry, if one place starts making huge profits, that's like a dinner bell ringing. New restaurants open up, and all that new competition drives those profits right back down. A monopolist is protected from that.
So let's make that comparison really explicit. The monopolist is protected by what economists call barriers to entry. Now, this could be anything from patents to having exclusive control over a vital resource, or just being so big that no one can afford to compete. These barriers, they act like a fortress wall, and they keep all the potential competitors out. In perfect competition, there are no walls. The second one firm starts making big profits, others just rush right in and poof, those profits vanish. This table really just crystallizes the whole argument. But let's focus on the row that matters most to a business analyst: price versus cost. You see, in a competitive market, firms get pushed to set their price equal to their marginal cost, pretty much just to survive. But a monopolist can consistently charge a price that is greater than the cost of producing one more unit. That gap, that space between the price and the marginal cost, that is the pure, tangible result of market power. And that's exactly where their sustained profits come from. So, this long-term profit engine, for a manager, it's the dream scenario. But for society as a whole, well, it raises some pretty big questions. This kind of power has major consequences for all of us as consumers, and for the economy, which is exactly why monopolies are always under the microscope. Yeah, from a regulator's point of view, this ability to keep making huge profits year after year is a massive red flag. It's basically evidence that the market isn't working the way it's supposed to. When a firm doesn't face any competitive pressure, it can lead to higher prices for consumers and a less innovative, less dynamic economy. And that's exactly when governments step in and start antitrust investigations, threatening the very fortress the monopolist worked so hard to build. So we'll leave you with this really critical question. From a societal perspective, we have to ask, if you can keep making money without any real competition, what's your incentive to innovate? Does a monopolist keep investing in risky R&D to make their product better, or do they just get complacent and sit on their cash cow? This is the central debate around monopolies. And for you as a future manager, it presents a fundamental tension. The very market structure that guarantees your profit might be the same thing that ultimately stifles the innovation that drives long-term progress for everyone.